welcome. Thank you for joining us for day one of Cherry Bekaert's 2023 Industrial Manufacturing Virtual Conference. My name is Matt Brady, and I lead Cherry Bekaert's Industrial Manufacturing Industry Group. We're very excited to have you here with us here today. Today, we're kicking off our 2023 virtual conference, which will feature several presentations on a variety of hot topics, recent developments, and proposed updates tailored to the industrial industry. The second day of our conference will take place next Tuesday, January 31st, from 1 to 3 p.m. Eastern, and feature a panel of esteemed speakers focused on addressing the ongoing supply chain revolution. We are excited about the lineup for this conference and hope you were able to join us for both days. A little bit about Cherry Bekaert. We're a top 25 accounting and advisory firm with over 1,400 professionals across the U.S., focused on providing proactive advice to our clients. We recognize the challenges facing industrial businesses, including rising inflation, increased interest rates, workforce shortages, and the global supply chain challenges. With an ever-changing business landscape, we strive to provide creative solutions, and in doing so, serve as your constant amidst change. We routinely partner with our clients to help leaders like yourself embrace change and invest in innovative solutions. As a good friend of the firm, Bob Nardelli, shared during our Modernizing Manufacturing event held last fall, you either innovate or you evaporate. With that philosophy in mind, we set our industrial manufacturing clients up for success by providing strategic tax and accounting guidance, as well as a full suite of advisory services, including supply chain advisory, which we'll speak more specifically to next Tuesday. Our overall goal is to help turn challenges into opportunities, propel new ideas, products, and solutions into action. Over these next 2 days, our intent is to do exactly that by speaking to the current environment while sharing our perspective on ways to successfully navigate and grow. So before we get started, I do have a few housekeeping items. First off, we'd like to hear how you learned about today's webinar. So please use the poll that was just populated to share your answer. We would also like to let you know that a recording of this webinar will be available in about 1 week's time. It will be sent out via email and posted to our website, www.cbh.com. Additionally, a short survey will be posted at the conclusion of the webinar. We value your feedback and ask that you take part. Your feedback helps us steer additional thought leadership and future webinars. Lastly, if you have any questions during the webinar, please type them in the Q&A window located in your control panel. We will weave those questions into the discussion or address at the end of each speaker's presentation. Now, with that housekeeping out of the way, I'd like to introduce our first presenter, Chad Newray. Chad spoke at our event last year, and we are thrilled to have him back with us today. Chad is the Chief Economist for the National Association of Manufacturers and will be presenting our first session on the U.S. and Global Economic Manufacturing Outlook for 2023. Chad serves as NAM's economic forecaster and spokesperson on economic issues and frequently comments on current economic conditions for manufacturers through professional presentations and media interviews. He's appeared on various news outlets, including CNBC. In addition, he is the director of the Center for Manufacturing Research at the Manufacturing Institute, the social impact arm of NAM, where he leads efforts to produce thought leadership, data, and analysis of relevance to business leaders in the sector. Prior to joining NAM, he was the chief economist and director of economic research for the Office of Advocacy at the U.S. Small Business Administration from 2002 to 2010. In that role, he was responsible for researching the importance of entrepreneurship to the U.S. economy and highlighting various issues of importance to small business owners, policymakers, and academics. Prior to working at the SBA, he was the dean of the School of Business Administration at Robert Morris College in Chicago. Clearly, Chad is an expert in this field, and we're thrilled to have him here with us today. Chad, I know I'm personally looking forward to getting a clear picture of what's to come in 2023. So with that, and no further ado, I'm going to hand it over to you.
Well, thanks, Matt. And hopefully life is clearer after this, but we'll see. We'll see. So I think, as you can see here, I am Chad Newray. I'm the chief economist at the NAM. also at the Institute, the Manufacturing Institute, where I run the Center for Manufacturing Research. And certainly we can get into workforce topics, I'm sure, as part of the Q&A. So before I get started too much, I'm going to leave it on this slide for a second, just to kind of set things up a little bit, right? Because while Matt wants things to be clearer, I think that there's still a bit of numbers on both sides, right? Depending on how you're tipping things, right? So on the one hand, clearly manufacturing activity is slowing. The global economy is slowing. People are worried about a recession, right? So there's a lot of negative numbers out there that we can certainly focus on. For those of you who get my Monday economic report, that's kind of how we led this week. Unfortunately, I depressed you first thing on a Monday morning. But so there's certainly are some negatives out there to focus on. Again, if you're an NAM member, you got that, the Monday economic report. If not, you can always follow me on Twitter and you can see it there as well. But at the same time, there also are some positives, right? So we don't lose track of the positives that are out there in the economy. The manufacturing sector has grown a lot over the last couple of years. And so while we're pulling back now, it's off of a pretty strong base. The labor market continues to be a bright spot, right? And so that certainly is something I think for us to focus on. And you know, there are reasons, ever increasing reasons for you know, some cautious optimism about the coming months. So I put that out there to say, I'm an economist. You expect me to say on the one hand, on the other hand, and I did that within the first minute. So now we'll dive into the overall charts where I'll show you a little bit of both of those, right? So just to kind of set that up. So we'll start with the NAM Manufacturers Outlook Survey. So this is a survey we've been doing for 25 years. You can see here that on average over that time period, 3/4 of our members are positive, either somewhat or very positive about their company's outlook at any given time, right? So that's the historic average. You can see the 3 shaded areas are the 3 recessions that we've had in that time period. A little spoiler alert that I do not have a recession for 2022, so that perhaps might be fodder for Q&A a little bit later. But I think the bigger news here is that at the end of the year, sentiment pulled below the historic average, right? And so we had quite a bit of deceleration in that optimism over the course of 2022, really beginning the year with 89% of our members positive and ending the year 20 points lower, right? At basically 69% of our members being positive. And that brought us below the historic average. And it also brought us to the lowest point in a little bit more than 2 years, right? So a little bit more since the third quarter of 2020. And in pretty much every sentiment survey, it looks like this, right? Where if you're reading my Monday report or you're looking at commentary, most of these data points are hitting, you know, post-pandemic lows, right? And so that is pretty consistent with what you're seeing elsewhere. At the same time, I think it's also important to note that even though these numbers have been weakening over the course of last year, that sales and production growth did not fall to zero. They didn't fall to negative, right? The overall expectations on average for our members in the fourth quarter survey was for 2.5% growth in sales over the next year, production to grow 2.7%. So these are very modest numbers, right? Certainly much weaker than, less than half of what they were at the beginning of last year, but still positive. And I think that is something that sometimes gets lost in translation when everyone is talking about contracting manufacturing activity on these purchasing managers index figures. So you see this kind of across the board, that decelerating activity, but still positive. As we move into the first quarter of this year, we are going to be going back out in the field in February to ask our members what they're thinking about for the next 12 months. So, I wouldn't be shocked if this continues to decelerate, but at least for right now, there's a bit more positivity there that perhaps meets the eye. We do try to estimate a PMI, Purchasing Managers Index, on the survey. And you can see that here, that at least in the fourth quarter, so if you're looking at the fourth quarter relative to the third quarter, production clearly contracted, right? If you're looking at that in that way, with a little bit more than a third of our members saying that production was lower contraction is probably the wrong word, was lower in the fourth quarter relative to the third quarter. Just about 24%, 23.5% said they were higher, and 43%-ish had no change. A little bit of peeling the layers of the onion back a little bit on how PMIs are calculated. A PMI is basically half of the no change plus all of the higher, right? So that's how you get these numbers. It was the only real number that actually was below 50. 50 would be neutral. Anything over 50 would be expansion. It was the only number that was in kind of that negative area. Both employment and capital spending were positive in the fourth quarter relative to the third quarter. So that was, again, a little bit of mixed news there. The number one issue that I hear from manufacturers, and I'm actually calling you today from Omaha, Nebraska, where I'm meeting with some manufacturing members of ours. The number one issue is attracting and retaining a quality workforce. And I hear that from everywhere I go, right? The top 4 issues on this chart really haven't changed that much over the last couple of years. But you did see in the fourth quarter, you saw supply chain and inflation move down the list to the second and third issues. That doesn't mean that they're not significant. You see, still roughly two-thirds of our members are saying supply chain issues are a challenge. Inflation still has more than 60% of our members saying it's a problem. But it is notable that you saw a little deceleration there. So perhaps some sign of optimism in the overall trend lines. And let's talk a little bit more about supply chain. So we've been asking this question for 5 or 6 quarters now. When do you think supply chain issues will get better? And you see here that roughly 11% of our members say that they already are better, right? So by the end of 2022, things were better, right? The bulk of our members expects supply chain issues will get better this year. And I guess if you stretch that into sometime in 2024 over the next couple of years, but 60% expect it to be this year. So this is what the survey says, but I do think it's notable. We did get S&P Global data this morning, ISM, a lot of these sentiment surveys. When you're looking at delivery times and a lot of other measures like freight costs and et cetera, it's clear, kind of like I was hinting about with the previous slide, that many of these data points are moving in the right direction. Now, they might be moving in the right direction for the wrong reason, right? These bottlenecks might be getting better simply because the global economy is slowing. But it's clear that at least anecdotally and at least in some of these sentiment data, some of these figures are getting better. Now, some things that aren't getting better, obviously the workforce, it depends on how you define what supply chain challenges are, right? I was just meeting with a member a second ago who said that freight costs for them on trains continue to be an issue, right? Workforce is still an issue. And so to the extent supply chain is affected by workforce, that is something that is not going away. And obviously the chip shortage, which has really affected a lot of manufacturers, even going beyond the auto sector, that's really more of a 2024, 2025 solution when some of those new foundries and facilities come online. But it is hopefulness that hopefully some of these supply chain issues will get better this year. The other this is the last slide I have for the NAM Manufacturers Outlook Survey. The other kind of talking point here is that more than 60% of our members expect us to officially slip into a recession this year. I've been hearing about recession really over the last 5, 6, 7, 8 months. This is my comment here is this is the most well advertised and predicted recession in history, right? Whether we actually go into a recession or not, I guess is still a bit of an uncertainty. But it's clear that our manufacturers are already thinking about one, and they have been thinking about one for quite some time. And the red flag here for me, at least as an economist, is that if you think we're slipping into a recession, that means that your hiring might be slightly weaker, your capital spending might be slightly weaker, maybe your sales expectations might be slightly weaker. And in that way, we somewhat talk ourselves into a recession, right? And so this is what the survey says. I actually think that the probability of a soft landing is perhaps more than we give it credit for. But there certainly continue to be more downside risks than upside risks in the economy. So drifting into and away from the Outlook survey, excuse me, into the ISM Manufacturers Outlook survey, the ISM Manufacturing Purchasing Managers Index. And we will be getting a new reading for this next week because this always comes out the first day of the month. So that would be February 1st. But you can see that this time last year, manufacturing activity was still pretty solid, right? It had weakened a little bit over the course of 2021, but was still pretty solid. And then started weakened even further with the Russian invasion of Ukraine. And then you got to the summer months when inflation was really rampant, and supply chain issues started picking up, and you saw some continued deceleration there. We ended the year with these PMI numbers being below 50, right, in both of the last couple of months, and that suggests that the manufacturing activity, at least in terms of these PMIs, was contracting. Almost every sentiment survey looks like this. So this is ISM, its competitor is S&P Global. We got a flash reading of that this morning. It also was contracting, and also a lot of the regional Federal Reserve banks. And so this is very consistent with a lot of the other sentiment survey figures that's out there. It is notable that we did see a little progress in some of the preliminary numbers for January. And so perhaps maybe we'll see a little bit of a rebound when we get the ISM number for January as well. But the data that we had at the end of the year in ISM is pretty consistent with what we had for manufacturing production. So if you get my Monday economic report, this was the graph this week. And you can see that we ended the year in quite a bit of a slump, right? Pretty solid declines across the board in both November and December. And so obviously we had a pretty solid couple of years kind of leading up to this, but those declines were pretty significant. And so it led you to some year-over-year numbers, which were not all that exciting. If you're a glass half full guy, which I am, you note that go back a couple months to that September-October time period, and manufacturing production and capacity utilization were both at levels that we haven't seen since 2008, right? And so the thinking there was that manufacturers needed to increase capacity, needed to increase production to be able to meet the demand, because everyone was buying goods, everyone was getting out there and doing stuff. And so that was really the storyline up until the end of the year. Those declines that we had in November and December were significant enough that we pulled back pretty strongly from those figures. One thing that I heard when I was meeting with members in the Dallas area, I don't know, probably around October or November, was that while we are seeing some pulling back in activity, we're pulling back from that strong base that I kind of suggested earlier. And so that, I guess, if there's any encouragement, it's if we're pulling back, it's pulling back from a pretty strong number. When you look at the overall manufacturing production data for December, you can see again, pretty much across the board, manufacturing production was lower. There was 3 sectors where that was the exception: aerospace, metals, and non-metallic mineral products. Every other sector experienced quite a bit of weakness in the month of December. And perhaps more importantly to me, looking at the year-over-year numbers, again, more negative than positive, but you do have some sectors that have bounced back pretty strongly over the last 12 months, really led by aerospace, which is doing really well in general relative to where it was a year or 2 years ago. But there are other pockets up there that also have performed well. Motor vehicles, you see, is positive. That has a lot to do with just how that sector has bounced back from the chip issues that really plagued it for all of 2021 and the beginning part of 2022. So that obviously is a nice sense of encouragement if you're looking for one. So this, the next chart is looking also at hard data. This takes us to November. We will be getting a new reading for this both on Thursday of this week, but also next week for all of factory orders. The number that comes out this week is for durable goods. I like this particular data point because it shows you the extent to which that's building off of that strong base comment that I made earlier. You can see how we've grown really rapidly over the course of much of the beginning part of this year, and then things kind of flattened out starting around the summer, and then it started to pull back a little bit more recently. I would expect when we get the December reading, this will pull back even further, kind of consistent with what we had in the manufacturing production data. One comment to make about both this chart and the next one is that these are factory orders, but these are factory orders in nominal terms. And so part of what is inflating these numbers potentially is inflation and higher costs. But still, I think overall, even with that, if you were to deflate that, these would be a somewhat encouraging number up until the summer. The other kind of thing that comes out of that particular report, and one that I continue to look at each month, and this is one of three charts that, at least to me, gives you a little bit of hopeful optimism about the future. This one is core capital goods spending. It comes in the factory orders data, and you can see that it continues to hit all-time highs, right? And so that, to me, this is a proxy for capital spending in the economy, and it gives you, at least for me, a sense that manufacturing activity, people continue to invest in their firms, right? So this is a sign of, if you're looking for hopefulness, this is certainly one of those. Again, this is in nominal terms, and so part of this could be inflation. But we do know that companies are continuing to invest in automation. There were more robots purchased last year than ever, right? Intellectual property spending in the GDP data continues to be a bright spot, right? And so this is somewhat consistent with that overall chart. And it's also consistent with a chart that I'm not giving you just because I don't want to give you 120 charts. And that is that manufacturing construction spending, while it pulled back in November, in October was an all-time high. And so that is, to me, another sign that companies were trying to increase their capacity leading up till the end of the year. And again, a hopeful sign that people are looking at the other end of whatever this recession or downturn or soft landing looks like, and planning for what happens in 2024 and 2025. The other chart that kind of mirrors this conversation is job openings, and we'll be talking about that when we get to the labor market. So moving away from the US and looking at the global economy. So for those of you who get my Monday report, you also get my global report. It came out last Thursday. And this is often the dashboard that I look at when I'm writing it. So this is the top 10 markets that we sell into in order. So everyone knows Canada and Mexico are our largest trading partners. You can continue to go across the list here. India is currently number 10. And you can see that 8 of the top 10 markets that we sell into had contracting manufacturing sectors in the month of December. That was the same pace as in November. So again, a continued weakness there. And when I look at this chart, I tend to bucket the world into 3 distinct buckets. Number one is China, right? China continues to contract. They really were hamstrung for much of last year by kind of the ridiculous zero COVID policy and all of the impacts of that. We knew that once President Xi was reelected, that would go away. And sure enough, it has. It went away a little quicker than I suspect even they thought because of the protests that happened there. But zero COVID is now gone. And now they're grappling with COVID. And hopefully they'll emerge from that. The other thing that China's dealing with is they're upside down in their demographics, right? You have more people dying, so the population actually declined in 2022 for the first time in certainly a few decades. And we would expect, because of demographic trends, that China is going to continue to grow slower over the next decade than we've kind of become accustomed to. They only grew 3% in 2022, assuming you believe that they grew 3% in 2022. And that certainly is going to continue to have ramifications throughout all of Asia. So in my view, as goes China, so goes Asia. If you start seeing some signs that China's rebounding, right, that obviously would be good for the global economy and certainly good for Asia. The other kind of related to that is China is considered to be an emerging market. I would quibble with them being called an emerging market, but that's how they're classified. So that's part of what's pulling the emerging markets lower. The other big part of that is that almost all emerging markets are export-led economies, and the slowing global growth obviously slows their overall economy. Many of them have been forced to raise interest rates to keep up with what we've been doing in the US, and so that obviously has not been helpful. And the third bucket has to do with Europe, right? Europe continuing to struggle because of the war in the Ukraine. As you get closer to the Ukraine, you tend to see much weaker growth, much greater dependence on energy from Russia. And so that has tended to pull much of the European economies down. I think, but to add to that conversation, Brexit has impacted some of the UK figures, but largely that's what's happening here in terms of those figures. The bright spot, I guess if I have a fourth bucket here, the bright spot, as you see, is India. India has continued to get better over the last few months, and that obviously has the highest PMI on this chart. And in my view, that has more to do with friendshoring of production moving away from China, potentially into India. So that is certainly something that is helping their overall economy. I'm going to express the same data in a candlestick chart. I'm probably the only economist that uses candlestick charts, which are probably more common in stock trading. But I like it because it shows you some dynamism of what's happening with these PMIs over the last 6 months. And if it's red, it means that the PMI, the Purchasing Managers Index, was higher 6 months ago than it is today, right? So that you've seen some weakening in these overall figures, and every one of these is red, except for India. So kind of going back to my previous slide a little bit. The other comment I'll make about the global economy, and then I'll switch to the labor market, is the dollar. So the dollar has been strong, right? That was much of the conversation of 2022, was a conversation about how the dollar continued to strengthen. We all know that at one point, the euro and the pound hit parity, right? Or was close to it for much of that time period. And so we certainly was, if you're looking at earnings reports and you're looking at the overall conversation, that strong dollar was really. But as you can see on this chart, the dollar really since October has decelerated and has actually fallen about 7%. That has a lot to do with kind of this expectation that the market has that the Fed is going to pivot at some point and start hitting the pause button potentially, and maybe even lowering rates later this year. I would question the second half of that sentence in terms of when they start lowering rates, but I do expect them to start pivoting and pausing on rates in some coming meetings. And so that certainly is going to continue to help the overall dollar depreciate. The other thing that has really moved the dollar lower is that many of the central banks around the world have kind of kept pace with us in terms of those rate increases. And so that has, in many ways, helped the overall currency, our currency at least, pull back a little bit. Okay, let's turn to the labor market, because this is one of the biggest strengths in the economy right now, at least it has been. And so we'll talk a little bit about 2022 and where I see these data points going moving forward. Last year, the US economy generated 4.5 million jobs, so a very strong year for job growth. And we ended the year, I mean, I know this chart looks like we softened a little bit in job growth, and that's true, but keep in mind 223 job, non-farm payroll jobs being added is still a very solid number, right? I would expect these numbers will continue to moderate over the coming months, perhaps moving into the 100,000s, and then maybe even having 80,000 or 75,000 or whatever. We might also see over the coming months some negative figures for some months, but overall the numbers so up to this point have been pretty solid. And because of that solidness, the unemployment rate is currently 3.5%, which is basically where we keep hitting that threshold. That was where we were in February of 2020, which was the lowest since December 1969. So we're still at what we economists call full employment. We've been hovering between 3.5 and 3.7 really over much of certainly the last 6, 7, 8 months. I do expect, to my comment a second ago, that the unemployment rate will start rising over the coming months, going over 4, potentially by mid-year, and maybe as high as 4.5 by the end of the year, maybe slightly more than that, but that's what my forecast would be. And so this kind of brings this larger conversation into question. Everyone is talking about a recession. We talked about that earlier. 62% of our members think we're going into a recession. We're having contractions happening in terms of manufacturing output. And yet we have full employment and full, it's kind of hard to just juxtapose the notion of having a recession when I use the phrase 4.5% unemployment, right? That those numbers are there's a disconnect there, right? Which shows you just how unique of a period we're in. Just to kind of flash back, not just ignore the pandemic for a second and go back to the Great Recession. You can see here that we peaked out at 10% unemployment during the Great Recession. And so if we had a recession in 2023 and peaked out at 4.5% or maybe even 5% unemployment, that's certainly less than half of what we had in the last one. So there's a bit of a disconnect there, and it really speaks to just how strong the labor market is and how even with some cooling off in the labor market, I would expect those numbers to still stay pretty solid. With that said, what is going to keep these numbers being a little unique is that the labor market participation rate continues to be at least a full percentage point lower than it was when the pandemic began. And we certainly have seen accelerated retirements. We've seen childcare and elder care continue to be issues for a lot of our members. The lack of childcare is a big issue. We hear about childcare deserts around the country. We know that immigration plays into this conversation as well. We know we're upside down in our birth rates, right? So that plays into this conversation. And there's just, for whatever reason, there are pockets of the population which have moved to the sidelines and have just not come back, right? One of those is just, for whatever reason, where did the young men go, right? And that's kind of this kind of rhetorical question we continue to ask ourselves. Part of that could be maybe they're driving for Uber Eats, or they're doing gig work, or they've started up their own business, right? So trying to answer this question about where do the workers go, I think, is one that policymakers are asking, but I certainly, as an economist, we ask that question as well. I do not expect the labor force participation rate to get back to where it was before the pandemic, and so that will continue to kind of exacerbate that skills gap challenge, and why it continues to be the number one issue for manufacturers. On the manufacturing side, we had the best year for job growth as a sector since 1994. So we added 379,000 workers in 2022. You see some cooling off there at the end of the year, only adding 8,000 workers in both November and December. And again, I wouldn't be shocked if these numbers turned negative at some point over the coming months. But building off of a pretty strong base, again, going back to my earlier comment, we have 12.93 million workers in manufacturing today. That's the most since the Great Recession, the most since November 2008. And so it certainly speaks to, again, everyone that I talk to says they're looking for workers. And so certainly we have been adding them at a pretty decent clip over the last couple of years. And I think the other kind of comment to make there is that job openings continue to be very elevated, right? So we have 779,000 job openings in manufacturing in November. We'll get a new reading for December next week. These data come out a little bit with a lag relative to the other job numbers. So we'll be watching that closely to see if that figure pulls back or stays pretty elevated. Over the last 12 months, this average has been 831,000 job openings. So again, very elevated levels of job postings. And part of what's kept that number so elevated is that manufacturers continue to tell us quite a bit about churn in the labor market. So I'm an economist. I used to be chief economist at the U.S. Small Business Administration. I love churn, right? Churn is usually a sign of health in the economy, right? People don't quit their job if they're worried about the economy, right? So that to me is a sign when people are quitting that people are overall pretty confident in their outlook. So with that said, I think we've had a very elevated levels of churn, and that has created some havoc in the labor market. We have seen quitting slow down a little bit, so it has come back from all-time highs that we saw earlier in 2022. Still elevated in terms of quits, but not quite as elevated as it was. And so that is, again, a sign that potentially we could see some reduced labor market growth moving forward. But again, if you're quitting your job, that means you have to post more postings. So this is a bit of a vicious cycle. The bigger ramifications of all of this is this chart, right? And that is that in November, we had 10.5 million job openings in the US. This is not manufacturing, this is everything. And only 6 million unemployed workers. So we continue to have more job postings than people who are unemployed. For every 100 job openings, there are only 58 people who are actively looking for work. You have seen some progress in this figure It had been, a 2-to-1 ratio. And so we've seen a little bit of progress there. But the fact that it continues to be upside down, right? The fact that we continue to have more job postings than people who are looking for work is why this is, in my view, a structural issue and one that is not going away. Regardless of whether we have a recession or not, this is still a topic we're going to be talking about this year and moving forward over the next decade. And this is the reason why everyone and their brother is looking for workers, right? And you don't need me to tell you that. You can just drive down the street and see signing bonuses and people advertising, for these pretty elevated levels of salaries, right? I was just at Aldi last week trying to buy some milk. And I saw they had a sign out front, that their starting salary at Aldi is $18 an hour, right? So you've seen some these overall starting salaries or starting wages go up to try to stay current with the really competitive labor market. And manufacturers have told me that they've had to raise wages several times over the last couple of years to stay competitive locally. And even with that, they're still struggling to find workers, which gives you this chart. So this comes from the jobs data. Well, again, we'll be revising that at the end of next week because we get new jobs data at the first Friday of every month. We saw 5% year-over-year growth in the December data for average hourly earnings for production workers. Just to put a number on this is $25.50 is the average hourly earnings for production workers in the US. Again, very steady growth, down from 5.7% last March and April, which was a 40-year high, but still pretty solid. These numbers will moderate over the coming months, largely because they're year over year, right? So I would expect this to come down to around 3.5 over the coming months. But again, solid wage growth in a very solid labor market. And so that certainly is something we hear about. Two kind of comments to make about this other chart. As impressive as 5% is on a year-over-year basis, we've seen even faster growth in other sectors, right? So, certainly in leisure and hospitality and restaurants and bars and hotels and warehousing and all the like. And so while manufacturing wages still are higher than most of those service sectors, that gap has narrowed. And so that's a large part of why we're competing with what I would consider to be non-traditional players for talent. And that has certainly for entry-level talent, especially, we hear that being quite a problem. The other comment that I'll make here is that as impressive as 5% is, the consumer price index is up even faster, right? And so in real terms, manufacturing workers' purchasing power has actually gone down. And we've seen that happen a lot over the last couple of years. And so that plays into the political conversation. It plays into what the Fed is going to do, et cetera. So that's my segue into talking about inflation. So the next three charts, I'm going to show you the three bigger measures of inflation. And I always start with this one, which we're going to get a new chart. I'll be updating this chart on Friday. So this is the PCE deflator. It's the personal consumption expenditures deflator. My comment is we economists make everything complicated. This is PCE just means personal spending. So this is the price index for personal spending. The reason why we focus on this chart is this is the preferred measure of inflation for the Federal Reserve. So if you're listening to Jay Powell give a speech, or anyone from the Federal Reserve giving a speech, they're going to talk about the desire to have core inflation hovering around 2% over the long term. And that's the red line. You can see the red line is nowhere near 2%. I don't expect it to get down to 2% by the end of this year, even. And so that explains a large part of why the Fed has been so aggressive, right? So let's back up a second, go back to this point last year. Certainly, we could have argued that the Fed should have started raising rates sooner, and I would be in that camp. But at this point last year, the federal funds rate was effectively zero, right? The range was 0 to 25 basis points. The Fed meets next week. They're going to raise rates another 25 basis points. So that is, so on top of the 75, 75, 75, 75, 50, they're going to lower that to 25 at their January 31st and February 1st meeting. They're going to raise rates another 25 basis points, more than likely at their March meeting. Then they'll either pause or do another 25 at the subsequent meeting, and pause after that point. But that's kind of where I see things kind of playing out. those increases bring us up to a Fed funds rate that is basically 5, right? So you've essentially gone from 0 to 5% over a very short period of time of like 12, 13, 14, 15 months, right? And so that explains a large part of what's happening in terms of the underground in the economy, in terms of how consumers are feeling. It explains what's happening in the housing market, which has essentially collapsed since February of last year. But it's all under this desire that the Fed has to try to wring out inflation in the economy. And the only way that they see doing that is to slow the economy enough that you can eliminate some of these pricing pressures. So that's this chart. The other two charts to note here is that there are signs, much like on the supply chain conversation, there are signs that pricing pressures are moderating, right? We will get the December number of the previous chart, right? And so that number I would expect that to moderate from its November pace, much like we've seen in the producer price and the consumer price charts. Again, part of the moderation here is these are year-over-year numbers, right? So more favorable comparison months. We've seen energy costs fall, and that has helped certainly the overall headline numbers. But some moderation here, I think, certainly has been welcome. Still at elevated rates, but moderating. The consumer price index has mostly just flattened out in terms of core. I think if I were to show you the month-over-month numbers, you'd see a little bit more moderation there. But what's keeping these year-over-year numbers for consumer prices higher is the shelter component, which is largely rents. It's food costs continue to go up at a very steady clip, around 13% year over year in the most recent data. You're still seeing people getting out and about. So transportation services continue to be elevated, right? So people who are going out and traveling, right? And new car prices are continue to be somewhat elevated, even though you're seeing some moderation there. And so those are what's really keeping this figure up. I would expect this number to moderate and consumer price index to be up about 3% year over year by the end of 2023. So progress from where we are, but still above the Fed's threshold of 2. So what has that done for consumer confidence? Well, consumer confidence hit an all-time low in June when gas prices hit an all-time high. And so we've seen that kind of bounce off of that low, but still remain more pessimistic than we would like. And this is largely a reflection of the fact that consumers, much like businesses, are worried about a recession, right? And so I think that level of economic uncertainty is what's kind of playing into these overall figures, and perhaps played a little bit into some of the weaker holiday sales than we would have liked to have seen. Okay, so let's turn to the economic outlook. So we'll be getting a new reading for GDP, the first reading for GDP on Thursday. And as you see here, my forecast for that number is roughly 3%, right? So yes, we had declining GDP in the first and second quarters of 2022, but we're going to end the year with a couple 3 handles, right? So 3.2 in the third quarter, and at least in my estimation, a 3% for the fourth quarter. Those might be high watermarks, because I would expect as you move into 2023, we're going to see weaker growth, much like you're seeing in some of the other data points that are coming out. I have 0.5 up here. I could easily, I was tempted to put 0 for a couple of those quarters, but I left it at 0.5. And then, I see the biggest risk for a recession happening in the first 2 or 3 quarters of this year, and then starting to come out of it by the end of the year and moving into 2024. You see overall 2.1% growth for 2022 and 1.3% for this year. I do want to talk a little bit about the upside and downside risks. There still are more downside risks than upside risks, right? The risk of a recession is out there, right? We had the conference board release the leading indicators yesterday. It has declined for 10 straight months, right? And so that certainly would be consistent with a recession that is coming. But I think the biggest downside risk that's out there, right, is coming from the Fed, right? And it's coming from the fact that monetary policy has very long lags, right? So all those increases that I just described to you a few minutes ago are going to start you're starting to see the effect of that as you move into 2023, right? We saw the impact on housing right away, but we haven't fully seen the impact on other sectors throughout the economy. And so that I always saw the bigger risk of a downturn for 2023 than for 2022. Obviously, if the Fed hits the pause button, that might be a sign of welcome relief. But that, again, we won't know the full effect of all of those for quite some time. The other big risks that are out there, slower global growth, right? Who knows how the Russian invasion of Ukraine is going to end, right? There's no clear insight there, right? So that's going to continue to create uncertainty in the markets, continue to create inflationary and pricing pressures, especially in Europe, but in the global economy for energy and food. And so that continues to be out there as a huge downside risk. There's increasing inventory levels is something that I hear from some of our members as well, right? They were keeping increased inventories anyway because of just worries about supply chain risk and perhaps hedging a little bit. But there are certainly pockets of the economy where you're starting to hear about excessive inventories, especially in retail. But depending on what company you're talking to in the manufacturing sector, you're seeing some of that there as well. That is certainly a huge red flag for a recession if we were to have that be a more persistent problem. And then the other thing that's out there is that we've been talking ourselves into a recession for months, right? And so the worry is that has a ever increasing impact on psychology and how people react to that. Again, so that's the downside risk. On the upside risk, the biggest upside risk that's out there is the labor market, right? The fact that we have 3.5% unemployment today. We could have 4.5%, over the coming months, but that's still a solid number, right? Wage growth is still expected to be pretty solid this year. So if you have a job, you're going to continue to spend, and you're seeing perhaps a bit more resilience there, some of those spending numbers, despite kind of these recession worries. And so to the extent we get that soft landing that the Fed is seeking, right? Or if we have a mild recession, I think what gives us that mild recession is the labor market and spending, right? And so that I think is one of the factors that's out there. The other tailwind, and I just simply put this up there, is that a lot of those infrastructure dollars that the Congress passed over the last year or so, that's starting to flow out the door. And so that's going to provide a nice tailwind for sectors, especially if you're in the infrastructure world, right? Construction or whatever else. That's going to provide a nice tailwind for you. In semiconductors, likewise, a lot of investment has been announced for new chips and foundries being created. Much of that's not going to come online until 2024, but that spending is happening this year. We hear other stories about reshoring as well, right? So those will all be tailwinds to the economy, hopefully buttressing any downside risk that you're having. And so that's how I kind of see this year kind of playing out in terms of the upside and downside risks. For manufacturing itself, this is how obviously we had that declining number earlier that I showed you. I see a shrinking overall for manufacturing production in 2023, largely in the first few months of this year, and then by the end of the year starting to come out of it, such that you have a decline overall for the average for manufacturing production of 0.2% this year, and then a 1.8% growth next year. So with that, I think we have about 12 minutes for Q&A. So I'll leave my contact information up there for a second, but I think we can go to some questions.
Yeah, I'll just throw out for anybody who's on, if we can certainly take questions, obviously via audio, or if you want to put them in the chat, feel free to do so. Chad, I guess I had the benefit, of course, of seeing your slides in advance, but one that I went back to a couple times was that downside risk and upside risk. I think the way, similar to you, I'm an optimist, but I think that slide was very helpful just to frame up all that you just talked about, but really frame up kind of where we're at and where some of those survey results come out in terms of confidence levels on the upside and the downside.
So one thing, I've met with two of our manufacturing members in Omaha over the last couple of days, and in both cases, they asked me about the tech layoffs. So I will go ahead and answer a question that has not been asked of me yet, but I'll go ahead and put it out there. Yes, we are seeing layoffs in the technology sector. I do think that they are isolated to technology. I think that there are some unique aspects in technology that don't necessarily flow to the rest of the economy. think in many ways what we're seeing happening there in the financial markets for tech stocks is that people are reevaluating those multiples, right? The stocks got a little overvalued, right? And so you're seeing a mini .com crash, right? If so to speak, right? And so those stocks. So not good if you're a stockholder and saw what happened to those stock values over the course of last year. And those companies are being forced to control costs. So that's why you're seeing some layoffs there. The worry for the larger economy is that people see that. They see this constant drip of layoffs in the news, and they interpret that as, okay, we're definitely going into a recession. And then so again, the bigger impact for me is the psychological impact of that. The JOLTS data that I showed you earlier, layoffs in manufacturing really haven't budged all that much. So at least for now, it has not trickled over into manufacturing per se, but at least in my view, it's more of an isolated issue for now.
Yeah, that was great. Yeah, and Chad, we do have 2 questions here, so I'll read them off for you. The first one is, how long do you think it will take for the core inflation rate to return to the 2% average the Fed wants?
So I think, certainly you're going to get closer to 2 as we move through the course of 2024. I don't know if we'll get to fully 2, right? And I think it's an open question whether 2 is the right number or whether it should be 2.5 or 2.25 or whatever number that might be. And I guess depending on your persuasion on the Fed or whether you're a hawk or a dove, you might have a different answer to that. But I think you're going to get closer to 2 core inflation by the end of 2024, right? In my forecast, it'd probably be around 2.1, 2.2, 2.3. What keeps those numbers more elevated than we would like are these wage pressures, which, once wages go up, they are a little sticky, right? And some of these other pressures that are out there. But I think the Fed might declare victory once they broach that 3 and move into 2.5 or even less than that.
Thanks, Chad. And there's another, which is, how fast do you think the move to automation is going to affect inflation, unemployment, and that wage growth you're talking about?
Well, we certainly have seen quite a bit of investments in these new technologies. I kind of talked about robots earlier. Certainly, I think that what that does is it really speaks to the fact that we should be, it makes me an optimist about productivity growth moving forward, right? And so obviously, for the most part, when we adopt new technologies in manufacturing, no one's really getting laid off. I mean, keep in mind, we're still struggling to find workers. So when I talk to our manufacturing members, when they're embracing technology, whether it's buying a new robot or AI or whatever else it might be, that requires a lot of upskilling of their workforce. It requires people to move around on the shop floor to maybe some other roles. But it's all productivity enhancing, right? And so when you think about wage growth, right? When you think of wage growth, you typically think of wage growth kind of in the classical kind of textbook sense of inflation, core inflation, plus productivity growth should equal what wage growth is, right? And so that should have a more productive worker is obviously one that should hopefully be more well compensated. I guess that's kind of where I'd see that kind of playing itself out. In terms of overall technology growth, I think the lack of workers is certainly something that has forced companies to look at technology in different ways. But again, that speaks to a much more qualified, much more well-educated and skilled workforce, which probably earns more money than a worker who might have done that role in the past.
Great. Yeah, thank you. All right. And actually, we have another one in here. So, Chad, we'll keep you here for another minute or two. So, any comments on the current debt ceiling issue, probability of a default, and the potential, obviously, the ramifications of that?
Yeah, well, this is one of those issues that unfortunately we keep having this conversation in my 12 years at the NAM. Obviously, we've already broached the debt ceiling, right? And the Treasury Secretary Yellen has invoked extraordinary measures, right? And I think that will allow us to get through about June under current estimates, in which case we either raise the debt ceiling or we default. And so what you're seeing play out here in Washington is a little bit of a game of chicken, right? Who blinks first? And certainly from an economic standpoint, from a credibility of a nation, of our financial system standpoint, no one wants us to default. Well, and so manufacturers are going to be urging us to raise the debts, raising the Congress to raise the debt ceiling, to not default, because that could have some pretty significant implications. Keep in mind the debt ceiling is there because the government has already authorized those dollars to be spent, right? So we can have bigger issues about about spending and revenues and all that kind of stuff, about debt and deficit and how we conduct fiscal policy. But the conversation about the debt ceiling itself is kind of a silly one that we unfortunately keep having.
Yeah, it goes back to what piques interest in the news, and then that drip you were talking about earlier that then everybody focuses on. Yeah. Well, Chad, I don't see any other questions coming in. So, and we know you're traveling there in Omaha. So once again, really appreciate you joining us today, and again, all the insight and predictions. It's really been helpful. So I know we did have some questions, but if there's any additional questions regarding the topic today, please feel free to continue to put those in the chat. Even if we don't have Chad with us, we can follow up. Or certainly if you want to have a more specific discussion or dialogue with Chad, I'm sure he'd welcome that.